Environmental risk is now an operational problem. Enforcement patterns in early 2026 are not a warning, they are a confirmation. For most of the past decade, environmental risk occupied a fairly comfortable corner of the organization. EHS teams tracked it, sustainability leads reported on it, and leadership heard about it mostly during annual reviews or the occasional agency inquiry. That arrangement is ending. What is happening now at the start of Q2 is not a regulatory spike tied to a new administration or a policy cycle. It is a structural shift in how environmental exposure gets realized as cost and who feels it first. The companies still treating environmental compliance as a documentation function are beginning to understand, often at the worst possible time, that the market has already moved past that framing. The gap between a notice and a penalty has closed. There was a time when a notice of violation came with room to maneuver. Companies could negotiate timelines, work through remediation plans, and manage their way toward resolution at a pace that kept the financial impact manageable. That window is narrower now, and in some enforcement categories, it has essentially closed. Federal enforcement data from the EPA's Office of Enforcement and Compliance Assurance points to a consistent pattern. Facilities with repeat inspection findings, particularly in air emissions and water discharge categories, are seeing faster conversion from notice to penalty. The negotiation runway that many compliance programs were built around is no longer a reliable planning assumption. The operational consequence is real. Penalties surface in financial statements. They trigger disclosure obligations. They affect borrowing terms and, increasingly, draw scrutiny from boards that are now expected to understand environmental liability as a material, financial exposure and not just a compliance footnote. If your EHS team is still operating as though documentation and reporting are the primary deliverables, Q2 is the quarter where that assumption gets tested. Facility-level records are part of standard due diligence. Now, one of the quieter changes of the past 18 months is how much more visible facility-level enforcement data has become, and how many different parties are pulling it. Insurers assessing environmental risk profiles, buyers conducting supplier diligence, and project finance teams evaluating site feasibility are all accessing publicly available enforcement records as a routine part of their process. This matters for operations leaders because the compounding effect is rarely anticipated in advance. A single notice of violation that moves to penalty stage can simultaneously affect a facility's insurance renewal, delay a permit expansion, and flag the site for enhanced inspection frequency. None of those outcomes is catastrophic on its own. Together, and arriving without warning, they create a planning problem that is genuinely difficult to manage in the middle of a quarter. The facilities most exposed are those where compliance history has been tracked internally but never analyzed for how it appears externally. That is a gap worth closing now, before someone else closes it for you. The insurance market is already repricing this. The clearest external signal that environmental risk has gone operational is what is happening in underwriting. Environmental exclusions, long a standard clause that most policyholders accepted without much scrutiny, are being applied more aggressively. In some cases, the scope of what is excluded is widening at renewal. Insurers are building environmental risk profiles from facility-level data that includes inspection history, proximity to regulated water systems, and violation records going back several years. Companies with poor profiles are not simply paying higher premiums. Some are finding that specific coverage categories are reduced or declined entirely at renewal, which means the risk does not disappear. It shifts directly onto the balance sheet. Analysis from the Insurance Information Institute confirms that property and casualty underwriters have become significantly more systematic in how they incorporate environmental data into risk assessment for industrial facilities. The implication for operations and finance leaders is direct. The insurance market is now functioning as an early warning system for environmental exposure, and it is not waiting for regulatory action to reprice. State enforcement is not following the federal lead. The assumption that federal regulatory posture sets the tone for environmental enforcement is, at this point, an operational liability for multi-site companies. Several major industrial states, including California, New York, New Jersey, Michigan, and Illinois are running their own enforcement calendars with their own data, their own statutory authority, and in some cases, their own expanded requirements that go beyond federal baselines. For a company with facilities spread across multiple states, a federal administration signaling restraint changes very little about what is happening at the facility level in those jurisdictions. State regulators are not coordinating with Washington. They are enforcing their own programs, and in a number of cases, those programs have become more rigorous, not less. The practical problem this creates is one of compliance architecture. Programs built around federal rulemakings and federal inspection cycles do not automatically account for state-level risk. That gap is increasingly where exposure accumulates, not in the regulatory categories everyone is watching, but in the ones being managed less carefully because they feel further from the center. What has to change before the cost arrives? The shift from compliance as documentation to compliance as operational risk requires decisions that go beyond hiring or software upgrades. They are structural decisions about how EHS connects to finance, how facility-level risk is communicated upward, and how enforcement history is monitored across jurisdictions. Do the operations leaders in your organization understand your facility's enforcement records well enough to explain what those records mean for insurance, permitting, and capital access? If not, that gap will be identified by someone outside your organization before it is addressed internally. Is penalty risk and permit exposure built into your capital planning cycle? These are not hypothetical numbers. They have cost profiles that belong in scenario modeling and budget conversations, not only in quarterly EHS reports. Are you monitoring state-level enforcement activity with the same discipline you apply to federal rulemakings? For companies with significant state-regulated footprints, the risk is concentrated at that level right now. Environmental risk becoming operational is not a future scenario being modeled by risk teams. The enforcement data, the insurance market behavior, and the state regulatory posture are all pointing at the same conclusion. The question going into Q2 is not whether this is happening. It is whether your organization is positioned to respond before the cost makes the decision for you. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.